It started with a whisper in the trading pits, a rumor so wild that most seasoned traders laughed it off at first. But by the time the sun rose over Canary Wharf the next morning, that whisper had turned into a roar. London market dead. Those 3 words spread through Bloomberg terminals, WhatsApp groups, and over coffee lines like wildfire. Nobody could believe it. For centuries, London had been the beating heart of the global precious metals market, but now, that heart was skipping beats, and maybe on the brink of stopping altogether. It all came down to one headline that flickered across screens at exactly 7:12 GMT, **HSBC $347 emergency. Panic doesn't even begin to describe the reaction. Not when a bank as massive and respected as HSBC sent out a board directive that sent shockwaves all the way from Threadneedle Street to the trading floors of Singapore and New York. A directive that wasn't just a suggestion, not just a warning, but an order. Exit 7.3 BAs by January 31st. That's right, billion with a B. And here's the kicker. There was no clear explanation attached, just the directive and a countdown clock that began ticking in the financial world's collective mind. Let me take you back to how this all unfolded. Picture London's precious metals market, brokers in crisp suits, fingers flying across keyboards, voices shouting offers and bids, and screens glowing with gold and silver prices. For decades, this was where the world came to hedge risk, manage portfolios, and trade bullion with confidence. London wasn't just a market, it was the market, but in the span of a few short hours, that legacy was being challenged, maybe even crushed. It began with a senior trader at HSBC London, let's call him Mark. Mark had been with the bank for 20 years. He'd weathered the 2008 financial crisis, Brexit uncertainty, and enough market shocks to last a lifetime. So when he got the call that Monday morning from the executive suite, his stomach dropped. The voice on the other end was calm. Too calm. "We need to talk about the metals position," the director said. "We need to reduce exposure. All of it. 7.3 billion ounces by the end of January." Mark blinked at his screen. Numbers danced in his head. That amount was astronomical. It couldn't be real, could it? Meanwhile, across the street in the gleaming towers of the London Bullion Market Association, known around the world as LBMA, executives were waking up to alerts and frantic messages. The LBMA was the very institution that set the rules for gold and silver trading in London. They were seen as guardians of market integrity. But that morning, their phones were blowing up. Brokers were demanding answers. Funds were asking if they should liquidate. And reporters were already sniffing around, hungry for an explanation. But the LBMA had nothing. No statement. No guidance. Just silence. And that silence bred fear. Back at HSBC, the board was holding emergency meetings. The directive wasn't just a suggestion, was binding. Something about risk exposure, something about regulatory pressure, something buried deep in legalese that no trader really understood. But the effect was immediate. Gold and silver prices began to wobble. Futures contracts slid. ETFs tied to bullion saw heavy movement. And traders began asking the impossible. Asterisk, is the London market dead? Asterisk, in the midst of this chaos was Leela, a junior analyst at a hedge fund in Dubai. She had built her career on studying metals, flows, and market sentiment. When her phone lit up with the HSBC emergency alert, she felt a chill. She quickly pulled up her models and recalibrated them a dozen times. Every signal pointed to one hard truth: the market was in shock. And yet, there was something about this situation that didn't add up. Why would HSBC offload so much exposure so fast? And why now? Across time zones in New York, commodities traders were stunned. They crowded around Bloomberg screens, watching as London's market liquidity dried up by the minute. One veteran trader murmured to his colleague, "This feels like 2008 all over again, but worse." His colleague just shook his head. Nobody had a clear answer, only questions piling on top of questions at the LBMA headquarters. Late into the night, executives were drafting a response. But every draft seemed worse than silence. If they acknowledged the situation, would it legitimize the panic? If they denied it, and the market kept crumbling, what then? They switched phones, sent encrypted emails, and consulted legal counsel. All the while, the clock was ticking toward January 31st, the deadline. HSBC had set to exit all 7.3 billion ounces. The next morning in London's metal exchange halls, brokers were speaking in hushed tones. Some were liquidating positions. Others were hoarding whatever they could, convinced prices would skyrocket once the dust settled. A few were speculating wildly, betting on rumors and half-truths being passed around over coffee. Everyone sensed they were witnessing something historic, a shift in the very framework of how precious metals were traded globally. But no one could put their finger on the exact cause. Meanwhile, analysts around the world began publishing their takes. Some said it was regulatory pressure from Basel or global capital requirements. Others whispered about sovereign central banks quietly reducing exposure. A few even floated the unthinkable, that there was a coordinated effort to undermine London's role in bullion trading. Theories spread like wildfire on social media and financial forums. But through it all, one central truth remained. No one had confirmed information. and uncertainty is the most dangerous force in any market. Leela stayed at her desk, running simulations and talking to contacts across Europe and Asia. Her phone buzzed with messages from brokers in Zurich, Singapore, and Hong Kong, each more desperate than the last. Everyone wanted a lifeline, a hint, a clue. But the only public information was HSBC's terse statement and the LBMA's silence. It was like watching a slow, deliberate unraveling, one that could redraw the map of global metals trading. Hours later, a source close to HSBC's board, speaking on condition of anonymity, whispered a partial explanation to a financial news outlet. It mentioned risk thresholds, capital buffer concerns, and an urgent need to de-risk the bank's portfolio. But it didn't explain why 7.3 billion ounces, or why by January 31st. And it definitely didn't calm the market down. If anything, it fueled more speculation because it raised even more questions than answers. Traders started asking about the secondary effects. What did this mean for vaults and London Brinks, Maltsamit, and all the others that held billions in gold bars? What about the paper contracts that underpin so much of the trading? What about ETFs and miners, and retirement funds holding metals as part of their portfolios? Could this domino effect actually impact retail investors who had no idea any of this was brewing? The tension became palpable. In cafes near the Exchange Square, groups of traders huddled, sipping espresso and staring at screens like they were watching the weather turn into a storm, because that's exactly what was happening. London's historic role as the center of the metals world was being questioned, and if it slipped, where would the market go? Dubai, Zurich, Shanghai. And then, just when it seemed like the panic couldn't get any worse, another alert flashed across terminals. LBMA, to hold emergency broadcast tonight. No details. No agenda, just the promise of answers or more uncertainty. Traders marked their calendars, analysts cleared their schedules, and the world waited. Because if the LBMA confirmed that London's metals market was truly in danger of collapse, or even structural breakdown, the implications could ripple through every corner of the financial world. Prices could spike, regulations could tighten, global trading norms could shift, and the centuries-old legacy of London as the global bullion hub could be challenged or even ended. The countdown to January 31st wasn't just a deadline anymore. It was a ticking time bomb in the heart of the financial world. And as the sun set over the Thames, millions of eyes turned toward that emergency broadcast, wondering, will the LBMA save the market, or confirm its demise? Stay tuned, because in our next part, we're going to break down exactly what that broadcast revealed, who's pulling the strings behind the scenes, and what this all means for you, whether you're a seasoned trader, a curious investor, or someone who just wants to understand why the London metals market is suddenly at the brink of history. The room was dim, the only light coming from the scattering of monitors glowing in the early evening. Inside the LBMA headquarters, the atmosphere felt heavier than the walls could ever show. Phones were buzzing, analysts were pacing, even the usually calm executives looked tense. It was clear, this was not just another market blip, this was something different. Something that might change the way the world thought about precious metals trading forever. As the clock ticked closer to the scheduled broadcast, traders around the globe were watching every movement in the London markets with hawk-like focus. In Dubai, Leela sat at her desk, eyes glued to the screen but mind racing 1,000 miles an hour. She had spent years studying the flow of gold and silver across global exchanges, but nothing in her career had prepared her for this. The HSBC directive, the LBMA silence, the uncertainty. It was like watching an earthquake underfoot, while trying to predict where each crack might lead. Across continents, in New York's Midtown offices, Mark, still reeling from his call with the HSBC board, was preparing for what could be the most important speech of his life. The trading floor was unusually quiet, the kind of calm that only comes before something monumental. Mark had always prided himself on being able to read the room, but tonight, even he wasn't sure what to make of it. Traders who normally cracked jokes at every downturn were now silent. Everyone knew something big was coming. At precisely 19 o'clock London time, the LBMA's chief communications officer stepped up to the podium in front of a bank of cameras. Flashbulbs popped, reporters leaned forward. Traders in Singapore, watching through live streams, held their breath. Everyone wanted to know, is this the moment of truth? But the first words out of the officer's mouth were cautiously vague, carefully measured, and only raised more questions. There have been unusual movements in the market this week, he said, his voice calm but strained. We understand the concerns that many of you have. We are closely monitoring the situation and will work with all involved parties to ensure stability and transparency. That was it. No clarification, no reassurance. Just a vague promise to watch and work. The room erupted in murmurs, and across trading floors everywhere, graphs wobbled up and down like a heartbeat on an ECG. People were left wondering, is that all they have to say? The broadcast ended almost as quickly as it began, and more confusion filled the air than before. In a quiet corner of a London cafe not far from the LBMA building, an old hedge fund manager named Simon sipped his tea and watched the live stream on his tablet. Simon had been in the metals market since before most traders at HSBC were born. He had seen Brexit shocks and pandemic volatility, and yet, the current atmosphere felt more destabilizing than anything he remembered. He turned to a young analyst sitting beside him and said with a grim expression, "They're hiding something. And whatever it is, it's big." Meanwhile, Layla in Dubai was reaching out to contacts in Zurich and Hong Kong. Every message back sounded the same. No one knows what's going on. The silence from custodians, vault operators, and other major market players was deafening. Normally, these institutions were quick to issue statements to calm nerves. But now, nothing. And the market hated nothing more than uncertainty. Back at HSBC London, Mark was still on the trading floor, where screens were lit with red and green numbers flashing like warning lights. Traders were squinting at price movements, trying to detect patterns that just weren't there anymore. Confidence, once the backbone of trading decisions, was now a rare commodity. Even seasoned players were double-checking their strategies, afraid that one wrong move could cost millions. In Zurich, one of Leela's old professors, Dr. Weiss, was pacing his study, books and papers scattered around him like the aftermath of a storm. He had spent his life studying market structures and risk dynamics, and when she called him about the HSBC directive, his voice turned quiet, much quieter than she'd ever heard. "This isn't just a trading shift," he said. "This smells like a structural change, something systemic." But what systemic change could force a bank to liquidate 7.3 billion ounces of metals? And why now? Traders whispered about rule changes and global capital requirements. Others hinted at regulatory pressure from unseen authorities. A few even floated the most unlikely possibility: market manipulation at a scale no one had ever anticipated. Every theory was wild, every possibility seemed plausible, and yet none felt like the full truth. In London's vaults, the silent giants that stored the physical gold and silver behind all these numbers, activity was quietly picking up. Trucks laden with bullion moved in and out under heavy guard. Operators, who rarely spoke to the press or even traders, were now fielding calls. But when asked what was going on, they said only that standard procedures were in place. Nothing out of the ordinary, they said again and again. But traders knew better, because in markets, nothing out of the ordinary almost always means something extraordinary. The next day, as the sun rose over Tokyo, gold prices opened with a spike that took everyone by surprise. Silver followed suit, and for the first time, exchange-traded products tied to metals saw unusual volumes of trading. Retail investors, who had been watching the chaos unfold from the sidelines, suddenly jumped into the fray, pushing prices even higher. Online forums buzzed with talk of a bullion squeeze, and rumors that central banks were quietly increasing their own holdings. But central banks, the giants of financial stability, were silent too. No statements, no movements reported, just empty air filling in the blanks where answers should have been. Leela watched all of this with a mix of excitement and dread. Every model she ran suggested that something unprecedented was happening. But every model also told her one thing: you don't get certainty in chaos. And right now, the world was drowning in chaos. Mark too was feeling the pressure. HSBC's directive was still real, still in effect, and the deadline of January 31st was now just around the corner. Every headline, every twitch in price charts, and every rumor weighed heavily on his mind. He knew that if the market didn't stabilize soon, the effects could ripple outward, impacting pensions, global trade, even the perceptions of national wealth tied to gold reserves. Simon in London, still at the cafe, took a long sip of his tea as he watched prices jump. "This isn't just about metals anymore," he remarked to the young analyst beside him. "This is about trust." Across the world, trust was being tested. Investors large and small were watching, waiting for a sign, a clue, a statement, anything that could break the fog of uncertainty. But the fog only thickened down in Hong Kong. Another veteran trader, Chen, looked at his screens with a weary expression. He had seen market cycles come and go, but never had the foundations of a market shifted so rapidly. "This feels like the calm before a storm," he muttered to his assistant, who just stared back, unsure of what to say. And then, just when it seemed like the tension couldn't get any higher, another alert lit up thousands of phones around the world. **HSBC to hold press briefing tomorrow. **, no details, no agenda, just a time and a name. Traders began to speculate wildly. Was HSBC going to explain the directive? Was the bank going to backtrack? Or were they preparing to reveal something even more astonishing? Social media lit up with theories. Analysts on financial news channels debated what this could mean. Everyone had an opinion, but no one had the facts. Leela leaned back in her chair, exhausted yet unable to look away. Mark stared at his screen with a sense of foreboding. Simon finished his tea slowly, eyes fixed on price charts. And somewhere deep in the LBMA headquarters, executives were preparing statements they hoped could calm a world already on edge. But one thing was clear: the next day could change everything. And as the world waited for HSBC's press briefing, no one knew whether it would bring answers or push the market into even deeper chaos. The day of the HSBC press briefing arrived like a storm on the horizon. London's financial district buzzed with unusual energy. Reporters lined up outside gleaming towers, cameras and microphones poised to capture every word. Traders from all over the world were glued to live streams, some pacing in offices, others leaning over their screens in silence. For many, this wasn't just another announcement. It felt like the moment when decades of assumptions about the metals market would either be confirmed or shattered. Inside the building, Mark sat quietly in a small conference room, his laptop open in front of him. He was not scheduled to speak, but the weight of the last few days pressed heavily on his shoulders. The directive to exit 7.3 billion ounces was more than a number. It was a force that had rippled through the financial system, touching pension funds, ETFs, and even private investors who had never imagined that London's market could falter. Mark thought about Lila and how she had been tracking the chaos from Dubai, her eyes probably wide with the same mix of excitement and dread he felt now. Meanwhile, across the city, Simon had called in favors to get a seat in the briefing room. He wasn't interested in the cameras or the journalists. He wanted context, history, and insight. For him, this was a puzzle of human behavior, power, and perception. How did a single board directive from HSBC trigger such a global reaction? The thought gnawed at him. He knew markets weren't just numbers, they were human, fragile, and often irrational. Outside the main conference hall, the cameras flashed constantly, capturing executives arriving with carefully neutral expressions. Inside, the HSBC board chair stepped up to the podium. The room hushed, all eyes focused. He cleared his throat and began to speak in measured tones, but the words were layered with ambiguity. The bank has made decisions to reduce risk exposure in our precious metals portfolio. This is part of our ongoing strategy to ensure stability, meet regulatory obligations, and protect our clients' interests. Every word was scrutinized. Traders in New York, Dubai, Hong Kong, and Zurich paused, searching for hidden meaning. Analysts tried to parse the statement, calculating the possible implications for bullion prices and derivatives. But the vagueness only fueled speculation. Was this a calculated liquidation to influence prices? A preemptive move against unknown regulatory pressure? Or was there an internal crisis the public would never know about? In Dubai, Leela's phone wouldn't stop buzzing. Her contacts were flooding in with fragmented reports. Vault operators moving gold bars under secrecy. Minor banks reporting unusual withdrawals. Rumors of private central bank interventions. Every fragment added to a growing mosaic of confusion. She realized that the HSBC directive wasn't just a market adjustment, it was a signal that something fundamental was shifting, and no single analyst or institution seemed fully in control. Back at the LBMA, the subplots were equally tense. The executives had been forced into emergency meetings to discuss potential fallout. They faced pressure from multiple angles, traders threatening to withdraw from London markets, auditors requesting explanations, and global investors questioning whether the LBMA could still guarantee settlement. Meanwhile, whispers spread that some senior members of the board were quietly lobbying for a shift of parts of the market to other financial hubs, potentially Dubai or Singapore. If true, it could mark the beginning of a long-term reordering of global bullion trading. As the briefing concluded, reporters swarmed, but answers were scarce. One journalist asked directly about the 7.3 billion ounces, how it would be liquidated, what risk it posed to the global market. The board chair smiled politely, but offered no details beyond repeating that it was a strategic move to ensure stability. The ambiguity hung in the air like smoke, and traders around the world immediately reacted. Futures contracts jumped, ETFs saw record volumes, and prices swirled in volatile patterns that left even veteran traders unsettled. In New York, Mark observed the numbers flicker on his screen. Clients were calling nonstop, some panicking, some demanding guidance. He knew that any wrong move could be catastrophic, not just for HSBC, but for the broader perception of trust in London as a metals hub. His own doubts gnawed at him. Had the board thought through every possible outcome? Or had urgency overridden prudence? Meanwhile, Leela began to see patterns emerge. She noticed that while the directive affected the market broadly, some regions responded differently. Asian markets seemed more cautious, while European traders reacted almost instinctively, moving fast to liquidate positions. She realized that this wasn't just about HSBC or London, it was about perception, psychology, and the delicate network of trust that underpins global finance. Simon, still in London, continued to follow the fallout from the press briefing. He spoke with junior traders who were on the floor when the directive first hit. Some confessed to panic-driven moves, selling bullion at discounts for fear of liquidity drying up. Others admitted they were speculating, betting that prices would rebound once the dust settled. Simon recognized the human drama at play: greed, fear, and instinct mixing with institutional pressure, creating a storm that might not be controlled even by the banks themselves. Across the globe, private investors began to act as well. Forums and social media channels exploded with discussion. Some believed the directive was an opportunity to buy undervalued gold. Others feared a collapse that could destroy savings. The market became a living organism, reacting not just to data, but to rumor, emotion, and fear. It was becoming clear that no single narrative could capture the complexity of the situation. Meanwhile, subplots were developing in unexpected corners. A small group of analysts in Zurich began secretly compiling data, suggesting that certain vaults in London were over. They whispered about potential gaps between paper contracts and physical holdings, gaps that, if true, could create a chain reaction worse than anything traders had imagined. Another subplot emerged in Hong Kong, where a hedge fund quietly accumulated bullion, betting that London's turmoil would drive prices up elsewhere. Across these different threads, the market was simultaneously fragile and opportunistic. At HSBC, late that night, Mark stayed behind long after most of his colleagues had gone. He reviewed internal memos, tracking every movement and directive. He understood that his own decisions in the next days could influence outcomes on a global scale. And yet, he felt powerless to fully comprehend the consequences. The board's directive had created a tension that wasn't just professional, it was existential. London's market stability, investor trust, and the very perception of HSBC as a safe institution were all on the line. Leila, in Dubai, prepared a detailed report for her fund. She wanted to anticipate how each move in London could ripple outward. Her models suggested that if certain subplots, vault reallocations, regulatory interventions, speculative trades played out together, the market could experience volatility not seen in decades. But the models also indicated one undeniable truth. No one could fully control this unfolding situation. As night fell over London, the city's financial district was quiet, but only in appearance. Inside offices, homes, and trading floors worldwide, people were awake, watching screens, speaking in hushed tones, and waiting for the next move. The HSBC directive had become more than just a board decision, it had become a story of human behavior, global interconnections, and uncertainty that spanned continents. And yet, the biggest questions remained unanswered. Why exactly was HSBC moving so aggressively? What role did the LBMA play behind the scenes? Could London maintain its position as the center of the precious metals market, or was this the beginning of a long-term exodus? Traders, analysts, and investors knew that the answers, when they came, could either stabilize the world's largest bullion market or push it into deeper chaos. In quiet offices, late into the night, people reflected on what had begun as a simple board directive. It was no longer just about gold or silver. It was about trust, perception, and the fragile network of relationships that make the global financial system work. Every decision, every rumor, and every subtle movement in price now carried weight far beyond numbers. The tension was tangible. The stakes were high, and the story was far from over. As the first light of dawn crept over the Thames, traders around the world braced themselves. The next chapters of this saga were waiting to unfold, promising twists, hidden agendas, and the kinds of market drama that could redefine centuries-old assumptions. And everyone knew one truth. In this game, every move mattered, and the London market's future hung in a balance that no one could yet see. The days that followed the HSBC press briefing were unlike anything the financial world had seen in decades. London's streets, usually bustling with confident traders and bankers, carried a tension that was almost palpable. Cafes that once hummed with casual chatter about spreads and margins now hosted whispered conversations about market collapse, regulatory crackdowns, and secretive vault movements. Every glance at a screen or scrolling news alert could shift sentiment in seconds. Mark's office was quiet, almost eerily so. The trading floor, usually alive with energy, had become a stage 4 cautious calculation. Every trader knew that one wrong move could spark a chain reaction, but the sheer scale of the HSBC directive's 7.3 billion ounces made it impossible to predict what that chain reaction might look like. Clients called relentlessly, some demanding immediate action, others asking for reassurance they couldn't truly provide. Every email and phone call added weight to Mark's shoulders, a constant reminder that the world was watching, and that trust could unravel in an instant. Leila in Dubai felt the same strain. She spent hours poring over price movements, vault reports, and whispered rumors from contacts in London, Zurich, and Hong Kong. Her screen was a chaotic mosaic of numbers and graphs, yet none of it gave her a full picture. The patterns were fractured, as if someone or something was deliberately obfuscating the truth. Every message she received hinted at decisions being made behind closed doors that could shift global markets in ways no one could yet measure. She began to feel the edges of anxiety pressing in. This wasn't just an analytical challenge. It was a test of instinct, patience, and timing. Meanwhile, in London, Simon moved between the LBMA headquarters and the trading halls, collecting stories and observing behavior. Traders spoke of odd instructions from managers, delayed shipments of bullion, and hesitations in contracts that had never wavered before. Simon recognized the tension for what it was. Fear, and not the kind you could calculate. It was raw, human fear, amplified by the weight of numbers, deadlines, and centuries of reputation. Every whisper, every glance, every market spike fed it. Across the globe, the ripple effects were intensifying. In New York, hedge funds adjusted positions minute by minute, trying to anticipate the moves that London's uncertainty might trigger. In Hong Kong, private investors scrambled to secure bullion as rumors of vault constraints spread. Even in Singapore, where the metals market operated on a smaller scale, traders felt the pull of London's upheaval. The world had become a network of nerves, all straining toward one central point. The countdown to January 31st. Back at HSBC, internal tensions were rising. Executives debated how aggressively to proceed with the directive. Weighing market stability against internal pressure from stakeholders, some argued that transparency could calm panic. Others feared that any detail revealed could ignite chaos. Mark sat in on these discussions, aware that the weight of their decisions could extend far beyond London. Every meeting, every memo, every strategy session carried an almost cinematic gravity, the sense that the smallest misstep could ignite a global chain reaction. Layla received a tip from a trusted contact in Zurich that vault inventories might not match paper holdings. She tried to confirm it, but her calls were met with silence or vague assurances. Panic, curiosity, and suspicion collided in her mind. She realized that no matter how much data she collected, the human element, the decisions, ears, and miscalculations of those in power was impossible to quantify. It was unpredictable. It was dangerous. As the days passed, the market's volatility intensified. Price charts in London flickered like lightning across storm clouds, with wild spikes and sudden plunges that left even veteran traders breathless. Analysts speculated that strategic liquidation was creating a feedback loop, but no one could know for sure. Rumors spread of large-scale repositioning by central banks, shadowy hedge funds, and vault operators. Social media buzzed with theories, both rational and paranoid, feeding the tension and making the stakes feel even more personal. Mark found himself alone late one night, reviewing internal communications from vaults, brokers, and trading floors. He noticed subtle patterns, small transfers that didn't fit the usual flow, instructions that seemed oddly urgent, and a string of trades that could, if timed incorrectly, push the market to a breaking point. His pulse quickened. He understood that they were approaching a moment where human error, fear, or ambition could trigger an event that no model could predict. In Dubai, Layla was on the phone with colleagues in Hong Kong and Singapore, trying to map the complex web of transactions. She realized that the market was no longer a place defined solely by numbers. It was a battlefield of human psychology. Every decision was influenced by rumor, every move amplified by fear, and every hesitation magnified by uncertainty. She made notes, set up alerts, and ran simulations, but deep down, she knew that the next week could bring shocks far beyond anything she had anticipated. Simon, in London, noticed a new subplot emerging. Brokers who had been quietly watching the market were now acting in small groups, coordinating trades, and whispering about potential hidden moves by HSBC and the LBMA. Simon could see the human drama unfolding like a chess game. Strategy, misdirection, and tension layered over centuries of institutional authority. He understood that this was not just about bullion, it was about control, influence, and perception. As January 31st approached, the world's eyes fixed on London. Every market, every vault, every investor felt the pressure. Traders barely slept, analysts barely ate, and executives spoke in increasingly cryptic language, aware that their decisions could tip the balance. The suspense was no longer a distant tension, it was immediate, visceral, and personal. Every email, memo, and phone call carried the potential to escalate the situation further. Layla watched prices jump again, then plunge, as small hints of liquidity shifts appeared on her screens. The volatility was like watching a storm build, each movement adding tension to an already fragile system. She realized that what had started as a board directive had grown into a global drama, touching thousands of lives and billions of dollars. And the deeper she delved, the more she understood that no single person or institution could control what was coming. Mark paced his office, feeling the same mounting pressure. Clients were calling with urgent questions. His own team was exhausted, yet he couldn't rest. The stakes had grown beyond profits or losses. They were now about trust, stability, and the fragile perception of control. One wrong decision, one missed signal, could trigger an avalanche. Even Simon, normally detached and analytical, felt the tension seeping into him. Watching traders navigate fear, watching executives try to balance disclosure and strategy, he realized that the climax of this story was approaching. Everything, the HSBC directive, the LBMA silence, the vault movements, the global speculation was converging. And then, as the final hours before January 31st approached, the market seemed to hold its breath. Every screen, every alert, every whispered call carried the weight of anticipation. Traders in London, New York, Dubai, Hong Kong, and Singapore were aligned in a strange, invisible web of tension, waiting for the moment when the hidden pressures, rumors, and strategies would collide. The countdown was no longer just a date, it was a heartbeat. The suspense was maximum, the stakes could not be higher, and every person involved knew that the next move, the next signal, the next whisper could define not only the future of the London metals market but also the perception of trust in global finance itself. As night fell over London one last time before the deadline, Mark, Leela, Simon, and countless others stared at screens, dashboards, and glowing charts. Somewhere, vault doors clicked shut. Somewhere else, trades were queued. Somewhere else, decisions were being made that no one would fully understand until much later. The tension had reached its peak. The world was waiting. The market was on edge, and no one could yet see which way the scales would tip. The storm was ready to break. As London's skyline darkened under the last streaks of twilight, the market's tension had already reached a fever pitch. Traders held their breaths. Analysts stared at screens as if their eyes could will numbers into submission. And executives in glass towers whispered in hurried, cautious tones. But just when it seemed that all eyes were fixed on HSBC's directive and the looming January 31st deadline, a second, more shocking layer of uncertainty hit the market like a thunderclap. That the first alert came quietly, almost innocuously, pinging across trading platforms worldwide. Asterisk, LBMA, Vault Audit Results, Immediate Internal Review. Asterisk, it was brief, vague, and buried in a routine bulletin, but for those who knew the context, it was explosive. Within seconds, traders in London, New York, and Dubai were scrambling. Analysts exchanged hurried messages, while whispers of hidden discrepancies in vault holdings began circulating like wildfire. The numbers, the supposed gold and silver backing paper, contracts might not match reality. What if the physical reserves were already What if the market had been operating on a dangerous illusion for years? Mark's heart skipped a beat as he read the bulletin. The HSBC directive was already monumental, but this suggested a structural risk that was far beyond a simple portfolio adjustment. He leaned back, his mind racing through worst-case scenarios. If the vaults couldn't cover what the contracts promised, the fallout could extend far beyond London's exchange halls. Investors, central banks, and hedge funds around the world could find themselves exposed in ways no one had anticipated. Leela's phone lit up with frantic messages. The whispers from Zurich, Hong Kong, and Singapore suddenly intensified. Her contacts hinted that some vaults had been quietly shifting bullion to private holdings, sidestepping usual reporting channels. One insider even mentioned a hidden layer of leverage that had never been disclosed, a network of paper contracts backed by thin reserves and secret agreements. Leela's stomach sank. The models she had relied on now seemed almost naive. This was no longer a story of market perception alone. It was a story of real, tangible risk hiding beneath the surface. Simon, observing from London, could feel the human drama intensifying. Traders who had already been acting out of fear were now panicked. Junior brokers whispered of sudden margin calls, while senior traders debated whether to halt transactions entirely. Simon recognized the signs. The second plot twist had pushed the market beyond calculation and into chaos, where instinct and fear dictated every move. The subtle manipulations and human reactions were amplifying the crisis exponentially. Meanwhile, in HSBC's executive suites, the board convened an emergency meeting. Normally calm and collected, senior leaders now spoke in tense, clipped sentences. Internal memos hinted at undisclosed risks in vault holdings, though no one yet had a full picture. Mark was present, and he felt the weight of secrecy pressing on him. The bank's decision to liquidate 7.3 billion ounces was already monumental, but now it had to contend with the possibility that some of that bullion might not physically exist where it was supposed to. Every scenario felt worse than the last. Across the globe, social media and financial forums erupted. Investors speculated about the LBMA audit, some convinced that London's precious metals market was unraveling faster than anyone could intervene. Rumors spread about hidden transfers, offshore accounts, and shadow reserves that might have been quietly manipulated. Retail investors and institutional players alike were caught in a storm of information and misinformation. Fear, greed, and uncertainty collided in real time. Leela, scanning through the data, noticed subtle patterns. Certain vaults reported movements of bullion just before public statements. Some trades coincided suspiciously with media leaks, and others seemed timed to influence perceptions of liquidity. She realized that the market wasn't merely volatile, it was being actively shaped by forces operating both inside and outside London's walls. The HSBC directive, the LBMA audit, the hidden leverage, they weren't separate events. They were connected threads in a rapidly tightening web of tension. Mark, still in the thick of it, began to connect dots he hadn't considered before. The HSBC directive was not just a risk management maneuver, it was also a signal to other players that the bank had anticipated a deeper, systemic vulnerability. And now, with the LBMA audit hinting at discrepancies, every trader and institution had to reassess not only their positions but their trust in the market itself. One misstep could trigger a domino effect, and the magnitude was impossible to calculate. In Zurich, a small group of analysts quietly began compiling data suggesting potential vulnerabilities in global bullion settlements. They spoke in low tones, aware that any leak could cause panic. Their preliminary findings hinted that